The bond yield curve is a graphical representation that illustrates the relationship between the yield, interest rate, and the maturity of debt bonds issued by the U.S. government. This curve is a critical tool for investors to gauge future interest rates and economic conditions. Traditionally, a normal upward-sloping yield curve indicates that longer-term securities have higher yields compared to short-term securities, a sign of economic expansion and investor demand for higher returns on longer-term risks due to inflation and other uncertainties. On the other hand, a flat or inverted yield curve, where short-term yields are close to or exceed long-term yields, often signals economic slowdowns or impending recessions. Established in 1913, the Federal Reserve has played a substantial role in influencing the U.S. bond market through its monetary policy. By adjusting interest rates, the Fed can either stimulate the economy by lowering rates, leading to a flatter or steeper yield curve, or cool down an overheating economy by raising rates, potentially causing the yield curve to invert. Historically, the yield curve has been a key indicator for economic forecasting. An inverted yield curve has preceded many U.S. recessions, which makes it a significant point of analysis for economic policymakers, investors, and central banks such as the Federal Reserve. Over the decades, the interaction between the Federal Reserve's actions and the yield curve has been extensively studied. Action in the past 20 years include the Fed's response to the 2008 financial crisis, where it reduced rates to near zero, initially flattening the yield curve, which then steepened as recovery ensued. The implications of an inverted yield curve are particularly noteworthy. This phenomenon occurs when short-term interest rates exceed long-term rates, reflecting investor expectations that future interest rates will fall as the central bank lowers rates to support a slowing economy. Historically, each U.S. recession since 1955 has been preceded by an inverted yield curve, typically 12 to 18 months before a downturn. This was evident in the recessions that began in 2001 and 2007, following inversions in 2000 and 2006, respectively. The inversion in 2019 similarly foreshadowed the 2020 recession, influenced heavily by the COVID-19 pandemic, highlighting the curve's reliability even in unprecedented circumstances. The impact of an inverted yield curve on the stock market can be significant. It often reflects investor pessimism about future economic growth, potentially leading to reduced corporate earnings expectations and subsequent stock sell-offs. Furthermore, the profitability of banks can be squeezed in such scenarios, as they pay out interest at short-term rates on deposits while receiving interest at lower long-term rates on loans, thereby reducing their lending activity and further slowing economic growth. Moreover, an inverted yield curve can trigger a flight to quality, with investors moving their capital from equities to government bonds, which are seen as safer investments during uncertain times and often pay higher yields than other investment options. This shift can further depress stock prices. Thus, the bond yield curve not only serves as a gauge for future economic conditions, but is also a crucial indicator of potential recessions and a vital tool for making informed investment decisions. In light of this, monitoring changes in the yield curve is essential for policymakers, investors, and economists to understand the broader economic landscape and its potential impacts on the stock market and the economy at large.